Hi everybody, it's Ben Morton from Cohen and Steers. We're the sub-advisor on the Argo Global Listed Infrastructure Fund. I'm really excited to be here today to talk about listed infrastructure with everyone. Listed infrastructure has performed quite well in the context of broader market volatility that we've seen this year. So as of September 30th, and this is in US dollar terms, infrastructure is down around 12 to 13%, which is again a period in which equities have been down around 25% globally and fixed income down around 19 or 20%. So clearly infrastructure doing what one would expect it to do as an asset class that's focused on more defensive businesses. These are businesses that provide essential public services. And again, we've talked about those downside protection characteristics given the predictability and the relative predictability of cash flows for these businesses. If you take a step back and think about the various subsectors of infrastructure, we've seen quite a bit of dispersion this year in terms of performance. So midstream, which is a subsector with the highest, I'd say, inflation beta, has performed the best. Some of the more defensive subsectors, the utility subsectors, have performed the second best. Then you move down more towards the economically sensitive subsectors like freight rails and marine ports. And then lastly, the worst performing subset within infrastructure has been some of the higher growth, higher multiple businesses. For example, water utilities in the US, which tend to be high growth, high multiple, as well as most notably telecom infrastructure, whether it's towers or data centers that have been hit disproportionately given their high growth, high multiple starting point. Lots of interesting developments in the asset class recently, many of which relate to sort of energy dynamics around the world. And you think about the implications of higher for longer energy commodity prices on many parts of what we invest in our universe. You can think about benefits to businesses in the midstream space, many of which do better amid this higher for longer energy commodity price environment because those businesses tend to benefit when production rises because that means higher throughput on energy infrastructure assets. You also have the distinct but related impact on things like LNG exports. And we invest in companies like Cheniere Energy that export LNG from the US to other parts of the world. Clearly there's been a big shift amplified by the Russia-Ukraine war towards energy security of supply and being a set of companies in the midstream space that are domiciled in a country or countries, meaning the US and Canada, that are self-sufficient from an energy standpoint and a source of growth for sort of global energy production is a favorable place to be relative to some of these other regions. On the flip side, you also have sort of some of the negative implications of higher energy commodity prices. That tends to impact utilities, right? Where in some parts of the world, customer bills have gotten so high that it's making for very tough sort of political dynamics as utilities attempt to pass through these costs to customers. So again, it's our job to understand and price these risks and opportunities. And in investor, we see the best opportunities at any given point in time. So that's probably the biggest theme that sort of resonates throughout the asset class over the last 3 to 6 months is the varied impact of the sort of energy dynamics globally and what they're doing across the infrastructure universe. We've talked about another theme that sort of has been around for some time in this asset class, and that is dry powder and the tremendous amount of capital that's been raised by private infrastructure vehicles to invest in infrastructure assets. Increasingly over the past several years, really I'd say in an enhanced way over the past 12 to 18 months, we've seen more and more of our listed companies impacted by that private capital. So what do I mean by that? Our companies and our management teams have been increasingly willing to sell assets, sell stakes in assets that they own, or even sell themselves to these either sovereign funds or private infrastructure vehicles. Several could be highlighted, but notably, Sydney Airport in Australia was one of the larger transactions that we've seen, but a handful of companies have sold themselves altogether. This has really been a global trend. Clearly, there's been an emphasis in Australia because we've seen 3 transactions in the last 18 months of companies effectively in the infrastructure universe going away by virtue of private investment. But this is something that we're seeing globally. But at the same time, I wouldn't say that it's one direction only, because we are seeing capital formation with IPOs of infrastructure companies in several parts of the world. So I expect to continue to see both trends over time. And clearly, one that is very impactful on our universe is this privatization theme. So the topic du jour continues to be rising interest rates, above trend inflation, and what's the impact of those dynamics on infrastructure. First, and I think you have to think about these distinctly. So first, in terms of higher rates, clearly this is an asset class that is capital intensive, carries a fair amount of leverage by virtue of the types of businesses that they operate. And the predictability of cash flows can support that leverage. So, historically, given that higher leverage profile, in extreme moves in interest rates, infrastructure often underperforms as sort of a knee-jerk reaction, but then tends to outperform going forward following that initial knee-jerk underperformance. Why is that? It's because a couple things. One, historically, the market's probably overcorrected relative to that initial extreme rate move. And then 2, when rates move, that may be accompanied by either strong economic conditions, which can support some parts of infrastructure, or it can be accompanied by a time of very weak economic conditions where more defensive business profiles shine through. And I think we've seen some of that dynamic occur this year. Folks have been more thoughtful and more wary of the slowing economic growth than they have of the rise in interest rates, and clearly infrastructure defends well in a slowing growth environment. If we think about inflation, infrastructure tends to perform well in periods of unexpected inflation, when inflation's higher than the market expects. Clearly that's an environment that we're in today. Why is that? It's because infrastructure businesses tend to have pricing dynamics whereby the prices they charge tend to be linked to inflation. Toll roads, for example, have, let's say on average, 50-year concession agreements with local governments, whereby they're allowed to raise tolls every year at a rate linked to inflation. So a very direct linkage that allows these companies to pass along a lot of these higher costs to their customers or the users of the assets. So typically an asset class that performs well across higher than expected inflation, even periods of above trend inflation, when inflation starts to fall, infrastructure tends to perform well relative to its own long-term average. So we spend a lot of time focused on ESG and integrating our views on ESG as it relates to our companies into the bottom-up work that we're doing. So infrastructure is a bit of a unique asset class when it comes to ESG integration, in that a number of the factors, particularly on the environmental side and on the social side, are factors that we have been integrating for as long as we've been investing in these companies. Why is that? It's because these factors are core to the operations of their business. So if you take, for example, utilities, many utilities are in varying stages of energy transition, meaning they're retiring their coal-fired power plants and transitioning to new sources of generation. So building new wind or solar facilities. We have to embed costs of retiring coal plants, costs and investment needed to spend on new generation, what is the regulatory treatment of that, et cetera. So we've been very focused on, in particular, energy transition risks and opportunities as we think about integrating environmental factors into our financial outlooks for these companies. From the social perspective, these businesses, again, are providing essential public services. They tend to be largely regulated. Service quality is paramount, right? You want to be delivering a good service to your customers, and if you're not, regulators will hurt you. They will allow lesser rates of return over time if you're not up to snuff as it relates to service quality. So we track service quality metrics. Many of our businesses have unionized workforces, so we have to think about labor costs over time. So a number of different factors on the environmental and social side that are often and comprehensively integrated into our bottom-up work on these companies. On the governance side, again, we've been very focused on governance as a public company ourselves. We appreciate the discipline of public market standards. We have our analysts vote proxies, which I think is a bit unique. We think they should be sort of operating on the front lines as it relates to the issues that companies are facing as it relates to proxies. We also view governance as sort of the most important of the pillars as we think about ES&G, because frankly, environmental and social issues are governed at the management level from each company. So we expect to see great boards, great management teams, and discipline as it relates to these other factors and being proactive from the standpoint of focusing on environmental and social issues. So governance is really the starting point for us as we think about how it all trickles down into our integration process. So I noted earlier that one bright spot within infrastructure has been midstream, and I expect that to continue to be a bright spot within the asset class. Again, North America is a source of supply for the rest of the world as it relates to energy, particularly natural gas, which we believe will continue to be increasingly adopted as a transition fuel. We've seen the EU come out and include natural gas as a transition fuel as part of their green plan. So I think companies in our universe that can benefit from rising production of energy in North America by virtue of their ownership of the pipelines that transport that energy or store that energy are of interest to us. Additionally, again, a company like Cheniere that exports energy from North America to parts of the world that are frankly short energy is in a very strong position today, largely by virtue of their ability to sign long-term contracts to drive more investment here in LNG export capacity. So that's one space that we like. We're also excited about renewables and the transition to renewables. So you'll know that one of the large positions in our portfolio is NextEra Energy, which is the leading owner and operator of both wind and solar in the Americas. Continue to think that climate change will continue to have an impact on investment in energy, and we think about what that's meant for, again, retirement of old fossil fuel plants and investment in renewables. So we continue to see companies like NextEra invest a lot, only supported further by the Inflation Reduction Act here in the US. But this is really a global theme. We're seeing governments around the world that are very supportive of renewable investments and providing economic incentives and political incentives to make that investment. It's not just about the generation, though. I'd highlight that generation is one piece of the pie, but transmission investment's a large one also, as we need to invest in the power lines that will connect these new sources of generation to consuming regions, right? So these high-speed transmission lines will be crucial to moving energy from places where the sun shines and the wind blows to city centers, for example.